So Americans are very gloomy about the economy, and Nouriel Roubini is going to help us understand why. Nouriel, do you understand these disconnects, why people are so bummed out, even though certain parts of the economy are doing quite well?
Sorry, I have a bit of a sore throat. Well, as you pointed out, first of all, the economy is doing reasonably well. You know, third quarter growth was 4.9%. Growth has been above potential. Inflation has been high. Has gone from 9% towards 3%. Unemployment rate is very, very low, below the structural unemployment rate. And job creation has been robust, slowing down right now. So there is a clear disconnect between what these polls suggest and what the actual economic data are. I think there are probably several factors that explain that disconnect. Factor number one was that inflation was quite high until recently, and it eroded the real wages, and wages were growing less than inflation. Therefore, there was a significant fall in the last year and a half in real wages. They're now going up again because wage growth is robust and inflation is falling, but for a while, inflation was rising. And people look at their pocketbooks and they see that food is more expensive, energy is more expensive, a whole bunch of other services are more expensive. And that's part of the problem. Secondly, there is economic insecurity about the future. Clearly, the economy is doing well right now, but there is a worry that eventually we may get into a recession. There's income and wealth inequality, and economic activity might slow down as opposed to picking up. Three, even if inflation is low right now, say 3%, the price level at which you're buying, say, food or energy or other services is higher. And the only way you could have a situation in which prices are lower the way they were before, for example, COVID, would be if we had a recession, and that recession would lead to a deflation. But that's not the way you want to get lower prices. So at some point, when inflation occurs, even inflation is falling, the level price is higher, so real income might be squeezed. And that's something that cannot be resolved, something we have to accept. So there's a variety of different factors that explain this kind of a economic malaise in the polls.
So we're not going to ask you to be a political prognosticator, but you are an economic prognosticator. Yeah. What do you think is going to happen in the economy during the next 12 months leading up to Election Day, which is basically a year from now?
Well, there were, there are three scenarios about the economy. One right now looks like highly unlikely, a real, say, hard landing, severe recession, and a financial crisis. 6 months ago with the banking problem, that was a risk. A year ago with rising inflation, commodity prices, that was a risk. That tail risk is lower. So the question is whether the economy is going to have a soft landing, where you go back to 2% inflation without any recession, or whether it's going to be a softish, bumpy landing where in order to achieve 2% inflation, you're going to have a short and shallow recession. I would say that the jury is still out on that. The economic data actually right now look like in the direction of soft landing. Growth is still above potential, inflation has been falling, and therefore we're going in the right direction. But interest rates are higher for longer. That may slow down the economy. There are geopolitical risks that might lead to a spike in energy prices, and therefore there are factors that could lead us to a short and shallow recession. And now, from a political point of view, even a short and shallow recession will be very damaging for Biden, because if there was a recession during an election year, of course his popularity will further decrease.
Yeah. So political polling is one thing, which is not an economic indicator, but consumer confidence surveys are an economic indicator, and many of them are terrible. I mean, they are recessionary. I mean, people's attitudes are similar to what they are like during a recession. Do you see no way in which people are going to feel better about the economy during the next 12 months?
Well, it depends. If in the next 12 months we have a soft landing, if growth stays above potential, if inflation falls further, if real wages are increasing, then I think the consumer confidence is going to be increasing over time. The consumers, by the way, have still a buffer of about $1 trillion of savings 5% of their disposable income they can use in case there is a slowdown in the economy. And that's one of the reasons why the economy is going to be stronger than otherwise. We have the CHIPS Act, we have the Infrastructure Act, we have the IRA. Those are going to be fiscal boost to the economy and to real incomes. So as long as the economy is going to do well and avoid a recession, I think consumer confidence is going to likely improve over time.
You think it'll improve over 12 months, enough to move the needle in the presidential election?
Let's put it this way, sentiment matters, but people look also at what's happening. If there is a soft landing, if economic growth is above potential, if job creation is still robust, if inflation is lower, if unemployment is low, I think at some point people are going to realize that their economic conditions are better than their foul mood. And some of that foul mood is also partisan. If you look at these polls, most Republicans, regardless of the economic conditions, think the economy is poor. Most Democrats think otherwise. So there's also a little bit of a partisanship.
Yeah.
There's a bit of a bias in these polls.
So you mentioned some of that big legislation Biden has signed. There was the Infrastructure Act in 2021. The so-called Inflation Reduction Act in 22, which had really nothing to do with inflation. That was about green energy mostly. The Semiconductors Act also in 2022. Some of this is not business as usual. This is a more robust government role in the economy. What are your thoughts on how this is affecting the economy, and is it going to do anything about income inequality, which you just mentioned?
Well, I would say that there was an economic doctrine of neoliberal policies that was actually bipartisan when George W. Bush was president, when Clinton was president, when Obama president. That was the view.
And that was more globalist, engaged with China.
Free trade, engaged with China, open up, free migration, small budget deficits, deregulation, and so on. For many reasons, this has led to income and wealth inequality and economic malaise. So it's out of the window. It was out of the window even before Biden came to power. If you think about Trump, his policies were completely different from traditional GOP that used to be in favor of big business, big tech, Wall Street, and you name it. So that movement towards more neo-populist policies, protectionism, and more government intervention in the economy, more subsidy to the private sector, more regulation, bashing big business, started under Donald Trump. The problem with Donald Trump was he ran as a populist, and he then governed as a plutocrat, tax act for the rich, bashing laborers and so on, while Biden has become a true neo-populist, and his economic policies, whether it's on trade, whether it's de-risking, whether it's controlling China, whether it's restricting migration, whether it's stimulating the economy with infrastructure, reshoring of manufacturing, friendshoring, and so on, go in the direction of rebuilding the economic and the job base of the United States. So in some sense, conceptually, Trump and Biden are close to each other, but one pretended to be a populist, while one is truly an economic populist.
So what is the outcome going to be of what Biden is doing with the economy? First of all, does it stand to think that this will last even if we have a change of administration? Because as you know, administrations flip-flop on policies. Is this sort of the new neo-populism here to stay? And is it going to address income inequality and many of the problems that Donald Trump actually kind of put his finger on in 2016?
Well, I think that regardless of whether Biden wins or Trump, policies that are of de-risking, of protectionism, of deglobalization, of decoupling on one side, restricting migration, a greater role of subsidies to favorite sectors that are strategically important, whether it's semiconductors or others, are going to remain. Of course, the policies of Biden and Trump on climate change are very different. Biden has passed the IRA Act, but that IRA Act is actually very popular in red states that are investing massive amounts of money into all this renewable energy. So it's going to stay. Those subsidies are going to be there regardless of who's in power. So I would say there'll be more continuity in terms of economic policy rather than differences between Trump and Biden.
I mean,
And on income inequality, I would say there's been a massive rise in income and wealth inequality. That's why even the GOP has become populist and against Wall Street, big business, big tech. It's not very easy to address income and wealth inequality, but if you can invest in your country, invest into infrastructure, invest in manufacturing, invest into reshoring, over time, those types of policy can help blue collar, white collars, and those left behind, regardless of who is in power.
you're endorsing protectionism to some extent, correct?
I'm not endorsing protection. I'm saying there are some elements of de-risking or decoupling that for geopolitical reasons we have to do. As Jack Sullivan said, we want a small yard with high fences to see what's actually truly strategic. And paradoxically, when Trump imposed tariffs against Chinese goods, those were just consumer goods. They were not strategically important. While in the case of Biden is semiconductors, technologies, and other things that are strategically important to the United States. So even if you want to do the risk, you have to do it in the right way.
Is there anything that you feel Biden should be doing in that regard that he is not doing?
I think that the biggest problem that we're facing is the one of our large budget deficits. Some of the strong growth is coming from very loose fiscal policy. It started under Republicans, first the tax cuts of Trump and then the stimulus during COVID, and it was continued by the Democrats. The trouble is when Republicans are in power, they cut taxes, but are unable to cut spending. And when Democrats are in power, they increase spending, but they cannot raise taxes as much. And therefore we have structural large budget deficits that stay regardless of whether the Republican administration or a Democratic. And now these large budget deficits are leading to a rise in interest rates, nominal and real, both on the short end and long end, and that can crowd out economic growth over time. So that's the biggest risk we face. So whoever is going to be in power, eventually fiscal consolidation is necessary. But because of the partisanship between the two parties, we're not going to have a resolution to this problem, especially of entitlement reforms, because our social security system and our Medicare, of course, are not sustainable. Pay-as-you-go system with large unfunded liabilities.
Yeah, okay, good. I'm glad you got into that. In just a couple minutes left, let's see how much we can cover on the bond market. Can you tell our audience how much of the recent increase in longer-term rates, the rates that affect mortgages, car loans, and so forth, how much of that do you attribute simply to the size of the U.S. Budget deficits, which is ongoing Treasury issues? Because there are other things going on. China is not buying U.S. Treasuries the way it used to. It's actually selling and things like this. So can you isolate out for us the effect of the U.S. fiscal situation on rising interest rates?
Well, the short rates have been rising because of the Fed tightening. Long-term interest rates have been rising in part because of a tighter monetary policy, but also in part because we have now larger budget deficits. The Fed, instead of buying the bonds, is doing quantitative tightening, selling them passively. The demand for treasuries from our strategic rivals, of course, is falling because they're worried about us seizing assets of China like we did for Russia, Iran, and North Korea. As the Japanese normalize policy rates, money is going to flow back from treasuries back to Japan. So the supply of treasury is going to be large because of the large budget deficits. Demand from actors, whether it's the Fed, foreign sovereign wealth funds, or private investment is falling. And therefore, the new equilibrium is one in which nominal and real yields are going to be higher for longer. I would say the equilibrium 10-year treasury is not anymore 1%, it's probably something like 5 to 6%. 2% inflation and at least 2.5% real rates.
So you wrote the book Mega Threats, which is out in paperback today, I think?
Yes.
Is this a mega threat?
Yes, in the first two chapters of my book, the first one is titled The Mother of All Debt Crisis. And I pointed out that debt to GDP ratio, private and public, implicit and explicit, have gone through the roof for the last 40 years. However, until 2020, while debt ratios were high, debt servicing ratios were low. Zero policy rates, negative policy rates, quantitative easing, credit easing. There were $18 trillion equivalent of public debt in Europe and Japan, up to maturity of 10 years that had a negative nominal yield until 2020. that part is over. As interest rates rise on the short end and on the long end of the yield curve, debt servicing ratios are now becoming higher and higher. And whether you are a household or a corporate or a business or a bank or another financial institution or a government or a country that's too much debt and leverage, eventually you're going to end up into debt distress. Now, if you're an emerging market, you have to default. If you're an advanced economy, borrowing local currency can always wipe out the real value of long duration fixed income through unexpected inflation. And that's what I think is going to happen. We're not going to default on our debt. We're going to wipe it out away with inflation over time.
Okay, I hope President Biden is listening. We have outlined the problems, started talking about a few solutions. Nouriel Roubini, thank you very much for joining us.
Thank you.